Hi, welcome to Arkintel. Imagine an economy so desperate for inflation, it actually wanted prices to rise. That's Japan. While the rest of the world fought to cool down overheating economies, Japan did something unheard of. It treated inflation like a missing miracle, a chance to escape decades of economic paralysis. But at first, it looked like it might work. But now, bond markets are breaking down, borrowing costs are soaring, and Japan's own prime minister just said something no investor wanted to hear. Our fiscal situation is worse than Greece. So, how did a country with one of the world's most advanced economies fall into a crisis because it tried to normalize? Let's unpack the experiment and why it may be imploding. For most countries, inflation is the villain. But for Japan, the nightmare was the opposite: deflation. And it wasn't imaginary. Post-World War II, Japan wasn't just growing, it was dominating. Between the mid-1950s and 1990, the country averaged nearly 7% annual GDP growth, transforming from a war-torn nation into the world's second-largest economy. Its exports flooded global markets. Its tech and manufacturing sectors led the charge. Then the 1990s hit, and the engine stalled. After a massive asset bubble in the late 80s, Japan's economy imploded. Residential real estate prices collapsed by more than 50%, commercial properties by roughly 80% to 85%. The Nikkei 225, Japan's main stock index, crashed nearly 75%. Growth flatlined, prices stagnated, wages froze. What followed wasn't a crash, it was a freeze. To get things moving again, the Bank of Japan went further than any central bank before it. First, it bought government bonds, then corporate debt. Eventually, it started buying ETFs, injecting money directly into the stock market. Debt ballooned past 240% of GDP, the highest in the developed world. And still, the economy barely moved until 2022. When inflation spiked globally after the pandemic, Japan finally got what it had been chasing for decades. Prices started to rise. For once, this wasn't a red flag, it was a green light. If inflation stuck above 2%, Japan hoped it would wake the economy up. Consumers would spend, businesses would raise wages, a virtuous cycle would begin, and the Bank of Japan could finally step back. And in 2024, it seemed to be working. Big companies raised wages by more than 5%, the sharpest jump in 33 years. Policymakers saw a chance to exit emergency mode. No more unlimited stimulus. No more buying bonds to keep things afloat. With inflation up and growth stabilizing, Japan could start acting like, well, a normal economy. Except it wasn't normal at all. Inflation didn't level off. It kept climbing, now at around 4%. And in a country trained to expect stable prices, this wasn't welcomed. It was infuriating. Public anger surged. Everyday staples like rice became political flashpoints. Households demanded relief. Politicians called for tax cuts, undermining the very budget stability Japan had hoped to rebuild. To cool inflation, the Bank of Japan raised rates to 0.5%, the highest since 2008. Sounds small? Not with this much debt. With over 240% debt to GDP, even modest rate hikes explode government spending. In fact, Japan is now forecast to spend 32 trillion yen just paying interest, about 5% of its GDP, one of the highest servicing costs in the world. And this was the beginning of the panic. In just a few days, Japan's bond market began flashing crisis signals. Yields on 30 and 40-year-old government bonds shot above 3%, the highest since the 1980s. So, what triggered it? Partly, it was global. The US saw bond yields spike after Moody's issued a warning on its debt. When America sneezes, the global bond market catches cold. But Japan had its own red flag, a failed bond auction. The government tried to issue fresh 20-year bonds, and buyers just didn't show up. Investors were losing faith. Why? Because Japan's economic recovery is still shaky. GDP contracted in the first quarter of this year, and Prime Minister Ishiba, now politically weakened, may not have the clout to rein in spending. Markets know this, and they are backing away. Now comes the hard question. Does the Bank of Japan intervene again? If it does and starts buying bonds again to calm markets, it risks reigniting inflation and weakening the yen, something the US, especially under President Trump, has loudly criticized before. But if it doesn't step in, rates keep climbing, debt costs surge, and Japan risks a full-blown fiscal breakdown. It's a loss-loss scenario, and it's entirely of Japan's own making. For 30 years, Japan delayed reality, patching holes with stimulus, avoiding structural reforms, and hoping low inflation would let them keep borrowing without consequences. But inflation is no longer the enemy they needed. It's the one they can't control. This wasn't just a miscalculation, it was a gamble, and Japan may be losing. For decades, the world saw Japan as a cautionary tale of low growth and endless debt. But when inflation returned, Tokyo saw an escape hatch, one chance to reset everything. That hatch is closing fast, and what's waiting on the other side looks a lot like the very crisis they tried to avoid. Let us know your thoughts in the comments below. If you found the video insightful, make sure to check out the video Why Europe's Strong Currency is Bad for Europe. In this video, we break down how Europe's surging currency could end up hurting the very economies it's meant to strengthen. From struggling exporters and shrinking profits to rising unemployment and economic slowdowns, the risks are real and growing. Click the video to watch now.